So, sir, I think my first question for you today is, what is ETF investment objective and strategy? Is it focused on specific sector and index, or is it like a broad based?
So, Ujjwal, ETFs, the acronym stands for exchange traded funds, which are essentially index funds that trade on the stock exchange on a real time basis. So, one has two benefits. One is the diversification of an index and real time pricing flexibility of a share. So, for example, if I have a Nifty 50 ETF scheme, then the underlying portfolio is the Nifty 50 index. And this, can be bought and sold real time on the stock exchange, exactly like shares. So, ETFs track various indexes. So you have the broad market equity ETFs like Nifty 50 ETF, Nifty Next 50 ETF, Mid Cap 150 ETF. Then you have sector products like, pharma ETF or bank ETF, where the underlying portfolio is the Nifty Bank Index or the Nifty Pharma Index. And also you have gold and silver ETFs and commodity and fixed income ETFs. So essentially ETFs cover all asset classes, equities, fixed income, and commodities. And essentially exchange traded funds are known as passive investments. When I say passive, what it means is that the underlying portfolio is an index. So there is no active stock selection done by a fund manager. Okay, so that risk gets eliminated when you buy an ETF.
Okay. So I think that was a clear-cut information on this sector. So I also want to know, like when we are doing the ETF, when we are buying the ETF, like what will be the expense ratio, and when compared to the other ETF of the same asset classes?
So ETFs being passive funds, the expense ratios are very low because there is no expensive research or fund manager cost that the traditional mutual fund scheme will have. So, for example, a Nifty 50 ETF, the expense ratio can be as low as 0.05%. Okay, and as against that, if I compare this to a large cap, alpha fund, because since Nifty 50 is a large cap index, the right comparison would be a large cap actively managed fund, which is the fund managed by a fund manager. The direct scheme expense ratio would be at least 1% or slightly over that. So multiple times, the ETF is cheaper than the competitive alpha products.
Okay. So when we are talking about all these like numbers and everything, we spoke about expense ratio. So now, can you tell us like how liquid ETFs are, and what is the buying and selling? How easy it is to buy and sell in the market?
So all ETFs may not be liquid. So let's take, for example, the Nifty 50 category of ETFs. Now, the liquidity is a function of the number of investors. So if an asset management company has a large investor base, then the, ETF liquidity is good. So, as we say, all ETFs are not created equal. A good part of the liquidity comes from the investor base. So larger the investor base, better is the liquidity. So one needs to compare the volumes of different ETF schemes, and schemes having the highest volumes is where the investors will have the lowest liquidity impact cost. So it is very essential to keep the ETF volume in mind when investing into an ETF scheme.
Okay. So like these are the basic things what we are discussing as of now. Probably when we talk about the expense ratio, liquidity, And the third thing which comes to our mind in general is the diversification. When we talk about ETF diversification, like is it completely diversified or it is like concentrated on one particular thing?
No, the underlying portfolio is an index. So the index diversification is a good diversification. So for example, let's take the example of a mid-cap 150 ETF. The underlying portfolio will be the Nifty mid-cap 150 index. So there, the investor is diversified into 150 mid-cap stocks. So ETF diversification because of the index is very good. And as I said right in the beginning, the two advantages of an ETF are uh, index diversification as well as real-time pricing of stocks. So these two combinations are available in one product.
Okay. And also like talking about the things, uh, one thing I have here in my mind is like when we compare things, like we usually compare things. So is there any benchmark that ETF has provided in the past, like in terms of performance? And is there an historical return which it has given to us?
So the benchmark is so in a Nifty 50 ETF, since it tracks the Nifty 50, the return of the ETF should be ideally very close to the returns of the total returns index of the Nifty 50. And likewise for mid cap 150, Nifty Next 50, or any other ETF that we consider. And as far as the returns history is concerned, is I think what your question was, that will be available in the respective fact sheets of the asset management companies. So all that since inception or last 5 years, 3 years, depending upon when the ETF was listed, those numbers the investors can easily refer to.
Okay, so one question I have, I think we can call it as a last question for the icebreaker session, and then I'll be handing over it to you for your presentation. So these are the basic things we usually talk about. And final question everybody is going to ask and everybody wants to know is about the risk involved with the ETFs. So can you throw some light on that?
So since ETFs are essentially indexes, the risk is only the market risk. So for example, if the market falls, obviously, whether you're buying stocks or, whether you have schemes managed by fund managers or the ETF, all will fall. Some will fall to a larger extent and some to a lesser extent. As the market recovers, the index will also recover. Some of the stocks may not recover as much as the index. They may fall short of the index rate of return. So ETFs essentially have only the systemic or the market risk. The additional risk, which is the non-systemic risk, which we call the stock-specific risk or the fund manager risk, those two risks are eliminated when you buy an ETF. Okay, so systemic risk, which is common to all investments, is what the ETF will also have. The non-systemic risks, which are the additional risks, which may not result in a higher return over the index, is what gets eliminated when you invest into an ETF.
Got it. Got it. So yes, thank you so much. I think we have Abhishek, Yukti, and Abhay who have joined the session. Welcome, guys. I think you are also getting more information on ETF from Sami Desai. Now he's going to take over the session and he's going to do the presentation for you guys.
Yeah, thanks, Ujjwal. So I'll just upload the presentation.
Yes.
Is this visible on the screen?
Yes, yes, it is visible.
Okay, so this is a presentation which is divided into essentially 3 sections. The first section talks about the advantages of index investing. So since the underlying portfolio of any ETF is an index, one needs to first understand why invest into an index. Okay, so that's the first part of the presentation. We'll see how Index investing also works in India, and it is getting popular in India. The second part of the presentation will talk about the how flexible ETFs are, how they can be used. So we'll dwell a little bit into that, and then I'll talk about how do you choose an ETF scheme. So when you have similar ETF schemes, what are the parameters investors should consider while choosing an ETF scheme? So as I said, ETFs are nothing but exchange traded funds. That is what ETF stands for. So index investing, why it is so advantageous? Here, let me also say that some of the largest mutual fund schemes in the world are actually ETFs. In fact, the largest mutual fund scheme in India currently is also an ETF. So that's how popular ETFs are. Now, this is what our traditional belief is, that portfolio managers who actively pick stocks, they will essentially keep beating the indexes. Hence, we should hand over our money to portfolio managers, which is what is known as active investing. So this is what we have been made to believe, that gifted people will pick great stocks and generate what we call alpha, or beat the index rate of return. This is what we believe, that this is the way to invest. Now, we will see some of the challenges which are there in the traditional methods of investment, which is active investing, whose endeavor is to generate alpha. So first of all, the alpha space in India, like the developed markets, is very crowded. So this is a table which tells you the number of registered entities in India which are into the business of alpha generation. So all your asset management companies, then your life insurance companies, FPIs, AIFs, that is, PMS schemes, portfolio management services. In fact, this table does not contain the data of treasuries, corporate treasuries, bank treasuries, pension funds, family offices. All these entities are into the business of generating alpha. So you have currently almost 16,000 entities and many more who are in the business of generating alpha. So this is a very crowded market. Now, assuming there are, let's take an example, just for the sake of understanding. Let's assume that there are 5 professionals per entity. That means you have a brilliant population, or a large population of brilliant chartered accountants, CFAs, MBAs, who are all competing with each other trying to generate alpha. So alpha is a crowded market, which is your traditional method of investment. So everybody mathematically cannot generate alpha at the same time. A paper was written by Professor William Sharpe, who won the Nobel Prize in Economics in 1990. And that paper was titled The Arithmetic of Active Investing. So all these guys are active managers. What this means is, if somebody picks good stocks in a particular time period and generates alpha, that is, takes excess return from the market, then as a consequence, because of mathematics, the other professional managers also engaged in the same activity have to underperform the market average or the index to that extent. So let's assume the market's average rate of return, that is all investors in the aggregate, the average rate of return is 15%. If some, fund managers generated alpha, let's say they gave a return of 17%, then by default, the other fund managers or portfolio managers in the aggregate will underperform to that extent. They will get a return of 13%. So mathematically, it is impossible for everybody to generate alpha in the same time period. And this is explained here, that investors as a group cannot outperform the market because they are the market. So in an increasingly professionalized market, which is what is seen here, where money is being increasingly managed by professionals, investors as a group are essentially professional managers. So professional managers as a group cannot beat the market consistently because they are the market. So if some managers outperform or generate alpha in a particular time period, the others will underperform to that extent. And to describe Professor William Sharp's equation, let me use a simple analogy from the Mumbai local trains. In the Mumbai local trains, we see that during rush hour, a lot of commuters rush to catch window seats. Now, window seats are limited in number. So, everybody will not get a window seat. So, let's say some commuters got window seats on a particular day. They generated alpha. As a consequence, the other commuters will either be hanging outside or standing in the passageway. So they are the underperformers. They did not generate alpha. They did not get the window seats. And somebody like me, who is an ETF, index, average, I did not get the window seat. I got the other seat, but I will reach my destination in a risk-adjusted fashion. Now, in the train journey, we see daily that the window seat catchers are changing. So folks who caught window seats on a particular day, they may be hanging outside or underperforming the following day. Okay. So everybody cannot get window seats and everybody cannot keep generating alpha in the train journey. Exactly like that in the market. Some fund managers, if they generate alpha in a particular time period, as a consequence, the other fund managers have to underperform the market average to that extent. So let's say the outperforming fund managers are gold medalists. I'm using an analogy from sports. The underperforming fund managers are bronze medalists. The index ETF is silver medal by default. So when you buy an ETF, because of the index average rate of return, you are assured of the silver medal position. The gold medalists and the bronze medalists, the outperformers and the underperformers in the market will keep changing all the time. But at least when you index, you are assured of the silver medal position. So having understood this advantage of index investing, a theory that flows out of this is, and which has been discussed in finance very often, that when you have a lot of skilled people competing with each other, luck plays a greater role in the final outcome. So the question that investors need to ask is whether alpha is a result of luck or is it skill, or how much of it is luck and how much of it is skill. So with this, let me go to the Indian data. Now, whatever I've said about the index, that fund managers cannot consistently keep outperforming the index, is actually seen in the Indian data. So this is the Standard and Poor index versus active scorecard. This is the traditional measurement for active versus index globally. Okay, so this data is prepared by S&P and it is prepared for India also, and it is released every 6 months. So this is the latest data for India for a time period ended June 2022. So if I take the first row here, the Indian large cap mutual fund managers, the alpha fund managers, if I take this number for a 1 year time period ended June 2022, 90.91% of fund managers underperform the large cap index. Okay, so essentially a large majority of large cap fund managers have given a return less than the index. If I take a 3-year return, 83.87% of large cap fund managers in India have underperformed the large cap index. And these are the numbers for the 5 and the 10 year. So this kind of data for India is increasingly seen in a lot of SPIVA scorecards for various time periods. In the ELSS space too, you see that majority of the fund managers, whether it is year to date, 1 year, 3 year, 5 year, are underperforming the respective index. Whatever little alpha is there in the small cap space. In fact, because the mid and small is combined here, we see that most of the fund managers are outperforming. If we see the mid and small cap segments separately, then you will find that in mid caps also, most of the fund managers are actually underperforming the respective mid cap index. So whatever alpha is there in India is essentially in the small cap space. Otherwise, the alpha has more or less vanished in the Indian markets because of competition amongst many talented fund managers. Let us see some more data. So this is again the large cap category and the compounded annualized return for 1, 3, and 5 years for a time period ended November 30th, 2022. We see that the entire large cap alpha category is giving a return less than the large cap index on an average. So these are the returns. This is the underperformance of the alpha category to the index in the respective time periods. This is further proof of how the fund manager rankings keep changing all the time. So this is the data from April 2013 to March 2022. And what we have done here is this is the actual data of the alpha funds. Only the names of the funds have been removed for compliance reasons. But these are actual schemes in existence in the market. So each fund manager has been assigned a particular color. As you can see, because of competition, the fund manager rankings are changing all the time. So for this particular fund manager who was top ranked with a black color, that ranking is falling in the subsequent time periods because of the competition. So if some fund manager was top ranked in one particular time period, let's say for 3-year time period ended March 2016, then his ranking is falling in the subsequent time periods, and some other fund managers who had a lower ranking in this time period are moving up in the ranking. So competition amongst highly talented professional fund managers ensures that alpha is not consistent. Individual alphas are no longer consistent. They change hands very quickly and they are transient. So nobody can consistently keep outperforming the market. When I say keep outperforming the market means keep outperforming the peers. The market is nothing but the peers. Okay, investors as a group. So professional investors as a group are the market. So one individual cannot keep outperforming the peers all the time because they are all talented and they all are engaged into research, fundamental research, technical research, and so on and so forth. So this is the challenge in the traditional method of investing. So how do we bring down this inconsistency of the alpha funds? If the alpha funds are going to be inconsistent in generating alpha, then I need to bring down that fund manager risk and the stock picking risk. So that is exactly what happens when I buy an ETF. So at this point, let me give a very simple analogy to describe what is an ETF. And I'm going to use an analogy from the Ramayana. In the Ramayana, there is an incident when Lakshman ji is injured and Hanuman ji is sent for stock picking, Sanjeevani booty. So instead of picking that stock or Sanjeevani booty, what he does is he carries the entire Nifty index or that mountain with all the jadi booties inside that mountain. So the index or the mountain that he carried, think of it as the Nifty 50 ETF or the Nifty Next 50 ETF. So by doing this activity, what you are doing is you are eliminating the need to find Sanjeevani booties or engaged in stock picking, whether it is directly or through fund managers. So you are bringing down the stock selection risk and the fund manager risk when you invest in the index. So this is the best analogy that I can give for an ETF. So what happened in the Ramayana is exactly what happening when you invest into an ETF. So let us look at some of the ETF data. Now, this is a typical trading snapshot of the New York Stock Exchange on a particular day, November 30th, 2022. As you can see here, the shaded rows are all ETFs. So the highest traded security on the NYSE on most days is an ETF. So this is the S&P 500 ETF whose volume on this particular day, November 30th, 2022, was $58 billion, much higher than some of the famous companies that we are aware of, like Tesla, Apple, Microsoft, Amazon, etc. And this is essentially what happens on most days. So increasingly, ETFs are dominating the volumes, daily average trading volumes on the NYSE. So what this tells me is that the investors abroad or in the US or in developed markets are doing away with the activity of stock selection or stock picking, whether directly or through fund managers, and increasingly investing in indexes via ETFs. So this is happening in the West, and this is slowly happening in India also. So the volumes of ETFs are going up in the on the American stock exchanges. This is how the ETF assets have grown globally over the last couple of years. In fact, ever since the first ETF was launched in 1993, which is your S&P 500 ETF, no other product has grown this fast in financial services history as have ETFs. So today you have, almost close to $10 trillion of ETF AUM globally. So it's a very, very large AUM, and this is rapidly going up. This is the chart for India. So India has also witnessed a rapid growth of ETF assets. Currently, the ETF assets in India are almost 5,20,000 crores, and this is increasing as a percentage of the total mutual fund assets very rapidly. In fact, the ETF investor participation is also growing rapidly in India. And as I mentioned earlier, the situation that we see abroad, some of the largest mutual fund schemes are ETFs. Likewise, the largest mutual fund scheme in India currently is a Nifty 50 ETF. So these are some of the catalysts in ETF growth in India. The government of India has been a major catalyst. In fact, provident funds, as per the government directive in 2015, they were asked to take exposure to equities. Their incremental inflows, as per the finance ministry mandate, minimum 5% should be in equities, up to a maximum of 15%. As a result of this government mandate, the EPFO, or the Employees Provident Fund Organization of India, which is a large pool of money, decided to take equity exposure via the ETF route. So they understood the advantages of the index investing route and hence decided to adopt ETFs for equity exposure. Insurance companies in India are also major investors into index ETFs. In 2014, the government of India decided to disinvest select CPSEs, or central public sector enterprises, via the ETF route. They understood the advantages of index investing and hence decided to disinvest CPSEs via the ETF route. So this has been a very successful offering over a period of time, and a number of tranches have come after the initial offering in 2014. Also, to encourage ETF participation, the government abolished securities transaction tax on ETFs. So as compared to stocks, the ETFs have negligible STT. Also in 2018, SEBI announced scheme rationalization, that they defined the large cap, mid cap, and the small cap space. So today, for example, if a alpha fund manager wants to invest into large caps, he has to essentially do it from the Nifty 100 portfolio. So this is the SEBI definition of large caps. 80% of the investments the fund manager has to do from the Nifty 100. Balance 20%, he has a leeway to invest into mid caps and other spaces. So what happened was, with this announcement of the regulator, the benchmarking became appropriate. When the benchmarking became appropriate, the alpha measurements became correct, and hence the alpha diminished. So this was not the practice prior to 2018. Prior to 2018, because these mandates were not there, the benchmarking was not all that appropriate. After it became appropriate, the alpha has diminished further into India because of proper measurements. So what is an ETF? If we recall the Ramayana example, ETF is essentially a diversified index, and it trades on real time. It trades like stocks at real time prices on the stock exchange. So essentially, index diversification combined with real time pricing of stocks is essentially the two advantages of an exchange traded fund. Uh, the operationally ETFs is exactly like buying and selling shares. So one buys an ETF scheme on the stock exchange through the broking account, and the delivery of the ETF share comes in the demat account. Instead of buying individual stocks, what happens is when one buys an ETF share, essentially one invests into a diversified portfolio as against buying individual stocks. So the stock specific risk gets eliminated in the ETF. And since one buys at real time prices, if the market is down, let's say at 10:30 in the morning, let's say the market has fallen 1,000 points, you buy at those real time prices. In the traditional mutual fund scheme, because of the day end NAV, if the market has recovered through the day, you will get the day end NAV. So the real time pricing of stocks is available only in ETFs. This is essentially, a diagrammatic representation of how ETF shares are sold and bought between buyers and sellers on the stock exchange, exactly like you buy shares of ABC or XYZ company. And this is how the market maker creates liquidity on the stock exchange. So if there's a large buy order or a large sell order, the market maker will automatically step in and supply units or buy units on the stock exchange. So that is how the ETF liquidity is created on the stock exchange. Now, let's look at how flexible ETF usage is. So asset allocation. Now, we all the time as investors, we keep hearing that asset allocation is the prime driver of portfolio returns. Majority of the portfolio returns are a result of asset allocation. So asset allocation is nothing but diversification into various asset classes like equities, fixed income, and commodities. So what this does is this reduces the overall portfolio risk. So if you have to use a very simple analogy of asset allocation, I can use the analogy of seasons. So summer, winter, monsoon, spring is something like asset allocation that nature does. Supposing there was only summer or only equities, okay, it would become very risky. So for overall growth, nature has provided us with various seasons: summer, winter, monsoons, and spring. That is some kind of an asset allocation. Exactly like that, investors should ideally diversify into asset classes like equities, fixed income, and commodities. And this is where ETFs are ideal for asset allocation, because indexes are asset class representative portfolios. What does this mean? Indexes are designed to capture the characteristics, properties, and behavior of an asset class. For example, Nifty 50 represents the large cap segment of the market. Likewise, mid-cap 150 index represents the mid-cap segment of the market. And likewise, a fixed income index represents a particular segment of the fixed income market. A bank ETF, where the underlying portfolio is the Nifty Bank Index, represents the banking segment of the market. So one can combine various broad market equity indexes, sector indexes, fixed income indexes, and commodities like gold and silver ETFs to construct portfolios to bring down the overall portfolio risk by practicing asset allocation efficiently. Cash equitization. What this means is, see, not many times investors are sitting on cash when the market falls. Now, when the market falls and you are sitting on cash, many a times there is confusion about where to deploy the cash, which stock to buy, which sector to allocate to, which fund manager to allocate to. One can eliminate this guesswork by straight away buying, investing into an index through the ETF. So when the market falls, the least one can do is at least invest into a broad market equity ETF like the Nifty 50 or the Next 50 or the Midcap 150 and start participating in the market. So what happens is When the market falls, you are not confused which stocks to buy, which fund managers to allocate money to. Uh, you straight away participate in the index or participate in the market. Why? By investing in the ETF. What is a core and satellite asset allocation strategy? Now, this is a very useful strategy where the core part of the asset allocation, we believe, should be in a broad market index ETF. By doing so, the investor is assured of the silver medal position that I spoke about initially. So one at least does not underperform the index, and one at least gets the index rate of return, whatever it is going forward. Okay? So if one cannot outperform, one will at least not underperform, and one will capture the index rate of return or the market rate of return going forward when you invest into a broad market equity index ETF. So this is what we call the core investment strategy. Now the core investment strategy uses beta or the index ETF to do your core investments. The satellite component of the asset allocation strategy can be into any of the alpha strategies. That is, you at least try to beat the index in the satellite component of the portfolio. So this is how you combine alpha and beta into core and satellite asset allocation strategy. What this means is that one can take calls into various sectors. So for example, if somebody is bullish on the pharma sector, then one can instead of buying individual pharma stocks or guessing which individual pharma stocks to invest in, one can straight away start participating in a pharma ETF where the underlying portfolio is the Nifty Pharma Index. Likewise, you can invest into various themes, sectors, and different asset classes using those respective ETFs. And one can always be a long-term investor or a short-term investor into ETFs. So overall, ETFs give you a lot of flexibility to do what you want. Now, having understood this, the question that may arise is, if there are a lot of similar, ETFs, then how does one select an ETF? So this is the table for the Nifty 50 category of ETFs. So here you have the various ETFs available, Nifty 50 ETFs available or listed on the stock exchanges in India. So these are all the actual ETFs. These are all the actual numbers. We have removed the names for compliance reasons. But what is essential here is one has to see the cost, that is the annual expense ratio. So here it is 0.05%, very low expense ratio. This is the large cap ETF. Then one sees the tracking error, which tells you how closely the ETF tracks the total returns Nifty index. Because smaller this number, better is the ETF. So for a 1 year number here is very small, 0.03%. And the most important number is the last column or the impact cost. This tells you how much is the volume or how liquid is the ETF on the stock exchange. So while these two numbers are important, that is expense ratio and tracking error, the most important number is the volume or the liquidity of the ETF on the stock exchange. Higher the volume, lower is the liquidity impact cost. So entry and exit into the ETF is very easy. Now this particular ETF has a daily average volume of 64 crores over the last 1 year, that is for the time period ended November 30th, 2022. And the second highest ETF, Nifty 50 ETF, has a volume which is much lower. And some of the other Nifty 50 ETFs have very low volumes. So daily average volume in the ETF is a very critical parameter for ETF selection. This is again the same kind of table with another ETF category, which is the Nifty Next 50 Index, the smaller large caps. Nifty 50 is the mega large caps. Nifty 50 is the smaller large caps. The 51st to 100th company is in this index. First to 50th company is in this index. So here also, the daily average volume is critical, much more important than the tracking error and the expense ratio. So I can show this for the bank category of ETFs. Again, the same kind of numbers. Daily average volume is critical. Gold ETFs, again, the same thing. So basically, when you select an ETF, the total cost structure is your expense ratio, tracking error, and most important, the daily average volume. The ETF has to be liquid. So having seen this, let us go to the Nippon India track record. So in passive investing, Nippon India, by the virtue of the acquisition of the Goldman Sachs slash benchmark, ETF business, has the longest track record in the industry of 20 years. So this is the oldest track record in the Indian industry for passives or ETF. The volumes of Nippon ETFs are the highest in the industry. Currently, the share is 71% of all ETF volume is Nippon ETFs. We have the largest folio share in India. So these are some of the, I would say, some of the first from the Nippon stable of ETFs. So essentially, a pioneer in ETFs in India. This is the Nippon bouquet of ETFs currently, the largest bouquet. So you have the broad market ETFs like Nifty 50 ETF, Nifty Next 50 ETF, Midcap 150. Then you have the various sector ETFs like banking sector, PSU Bank, IT, pharma, auto, thematic ETFs, which are some of the smart beta ETFs, the fixed income ETFs, which are target maturity ETFs, money market ETFs, and the gilt ETFs, as well as the two commodity ETFs. So a large bouquet is available for asset allocation and an all ETF portfolio construction. So if I have to end, let me quickly summarize that ETFs are essentially passive index investments. So that means they are low cost. You eliminate the risk of stock selection, fund manager selection. You do away with the risk of underperformance. One is always assured of the silver medal slot, and one will participate in the market rate of returns or the index rate of returns, whatever they are going forward. So the index is the only portfolio which is the genuinely long-term portfolio, because the index will always remain. Other investments will either keep outperforming or underperforming. Stocks will keep coming and going. So the index is like, if I may use an analogy from our scriptures for the last time, the index is like the Virat Swarup of the market. Individual stocks are Nashwar. Nashwar, when I say the individual stock, which is the blue chip today, may not remain a blue chip forever. So invest in the Virat Swarup of the market or the index via the ETF. Thank you so much.
Thank you so much, sir. Thank you so much. That was a it was like almost half an hour that you spoke, and you gave so much of insights with all the data and structure. So like, I think now we have Yukti and others who are also attending the session, and also we have some of the questions which were asked. Like you spoke on so many things. I think we can stop the screen sharing so that we'll have a small kind of interaction.
Sure.
So you touched on so many things, but like at the end of the day, everybody are concerned about their money, and also the other part of personal finance is the taxes. So are there any tax benefits when we are doing an investment in ETF?
So, the ETF taxation, because they are mutual fund schemes, is identical to mutual fund schemes. So equity ETFs will be taxed exactly like equity mutual fund schemes, and commodity and debt ETFs have the debt taxation. So the debt mutual fund taxation. When I say debt taxation means more than 3 years is the long-term capital gains with indexation. Less than 3 years is the short-term capital gain. So taxation is identical to the equity and the debt mutual funds.
So like when probably somebody like me, if we are entering into the market and if you want to buy an ETF, like is there a fee that we need to pay like upfront, or like is it only the exit load that we need to pay? So please throw some light on that.
Yeah, so there is no entry load or exit load. So there is no exit load essentially. basically one needs to pay a brokerage to your stockbroker, whatever is the brokerage rate applicable. So you have the discount broking entities also available now. You have the full service entities also. So whatever is the brokerage applicable for buying and selling shares is exactly like is the brokerage applicable for buying and selling ETFs. And the other cost is the annual expense ratio of the scheme, which is what I discussed earlier.
Okay. And one last question is, how does ETF gonna fit in the overall investment strategy and risk tolerance? Is it appropriate to have the financial goal and risk profile?
Yeah, so like any financial planning, one needs to keep the objectives in mind, the financial objectives and the risk profile. So as I said, ETFs will have the systemic or the market risk, the non-systemic risk or the security selection risk, and the fund manager risk gets eliminated. These are the two basic risks of investing. And if we refer to the core and satellite asset allocation strategy, we believe that the core part of the portfolio should be essentially in the broad market index ETFs like Nifty 50, Next 50, Midcap 150. So one gets at least the market rate of return, whatever it is going forward. So at least one, if one cannot outperform, at least one obtains the market rate of return and does not underperform. Okay. So this is what one should do.
Okay. So I think this was a great insight. Like now everybody knows, like if we are running a race, like at least silver medal is fixed for us. So I think it was a great insight and it was a great session. Thank you so much, Samir Desai. Thank you for being on our show with our Bullsmart. Hope to have a more discussion with you. Hope to have more webinars with you in our upcoming days.
Thank you, Ujjwal, for having me over. And thanks to all your participants and investors. Thank you so much.
Thank you, guys. Thank you for joining in.